Warren Buffett has been one of the greatest investors in history. I think probably the best investor in the lifetimes of anybody that's watching this video. I've read just about every book that's been written about Warren Buffett. I'm always looking for clues, ways to learn from the best. More recently, one of the things I've been doing is taking a closer look, not just at what's in the Berkshire portfolio, but how those investments have performed over the period of time that Berkshire has owned them. I took a look at some of the largest holdings in the Berkshire portfolio, and I was stunned to learn that a lot of them actually have underperformed the market. But even with that being the reality, I also learned some valuable things that I think we can all apply to our own investing processes to become better investors. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. It's fool.com/unscripted. Go to that link. The Motley Fool is going to give you 10 great stock ideas. You should check it out right now. I want to go back to a video that we did on this channel not too long ago, earlier this year, that you should check out. And it's some facts about Coca-Cola. And one of the facts that was really important, really jumped out at me, is that Coca-Cola, since Berkshire finished building out its position in Coca-Cola back in 1994, it's actually done a lot worse than the S&P 500. It's up 1,000%, which is actually an 11x in total returns. The S&P 500 is up almost 1,900%, so 20-fold return by the S&P 500 over that same period. I did a video on that earlier this year and decided to start taking a closer look at other stocks in the Berkshire portfolio. Berkshire owns a lot of stocks. There's more than 50 stocks in the Berkshire Hathaway portfolio. The reality, though, is that despite there being that many stocks, the portfolio is pretty concentrated. Of course, a lot of that is because of Apple. And yes, we're definitely going to talk about Apple in this video, but there's a lot of concentration in the top 10 or 15 stocks that Berkshire owns. And I'm going to talk about some of the key ones right now, and I'm going to use 2016 as the starting point for this data. It might seem like I'm cherry picking, but it'll make sense when we get to it. I'm going to pull up a chart that shows how some of the largest investments in the Berkshire portfolio have done since the beginning of 2016. First, American Express, which is one of the 3 largest holdings, up 259%. That's total returns, includes dividends that American Express has paid. Now, that's a solid result, and it's certainly better than the 191% that the S&P 500 has generated during that same period. Now, there's another 3 pretty large investments that Berkshire holds that haven't done as well as the S&P 500. So we mentioned Coca-Cola. Over the long term, it hasn't done well, but again, since the beginning of 2016, also vastly underperformed the S&P, up about 81%, still making money. Now, right above that, we have Bank of America, 155% in total returns. A solid result, but far worse than the S&P 500 has generated since 2016. Down here at the bottom, Kraft Heinz. This is one that Buffett has talked about as being a bad investment. The timing wasn't great. His expectations for powerful consumer brands and the ability of these brands to compound, generate really good operating leverage, and do well across any environment. Needless to say, this is one of the rare losers, true losers in the Berkshire Hathaway portfolio. Of these 4 stocks, only one of the 4 has outperformed the S&P 500. Of course, the one that I'm leaving off here is Apple. And I haven't included Apple yet for the simple reason that this is the first lessons. There's 2 lessons really that we learned. Number one, if Warren Buffett can't beat the market with every stock that he buys, it's bonkers to think that you should too. One of the greatest investors of all time doesn't beat the market every time he picks a stock. Don't expect that you're going to do it either. The reality is it's really hard to beat the market, and slugging percentage over batting average, apply a baseball term here, it's spring training's happening right now, may be a better way to think about it. I'll explain what slugging percentage versus batting average means to those that don't know. And the short version is batting average is the percentage of times that you get a chance to do something, you get on base, you get a hit, you get a base hit, right? So the higher the percentage, the better you're doing. Slugging percentage is how many bases you touch, the percentage of bases that you touch for every chance that you get. Hitting home runs, getting the big hits maybe matters more than just getting on first base. I'm going to share that same chart, and I'm going to add Apple to it because I think it's really going to put some context into the second part of this lesson. Same chart we see here. American Express, great run, definitely been the best performing stock of this group. And then 3 other laggards, one of which that is losing a significant amount since 2016. Again, that's 8 years. That's a long time. So what changed in 2016? Why is that important? Because that, my friends, is when Berkshire started acquiring Apple. And of course, Apple has been on a massive run since then. The stock is up sevenfold, 622%. What can we learn from that? I'm going to leave this chart up as I talk about it. The first thing we can learn is that this is where slugging percentage comes in. The great thing about investing in individual companies is it's not a horse race. We don't have 5 horses here and one wins and the other ones all come in other places that are not winning places, right? This is a compounding gain. This 622% in returns, not only does it add on top of the winnings of these other stocks, but it more than makes up for the losers. Another really important part of it is not only did Berkshire start buying Apple in 2016, it would go on to make Apple the largest investment in the Berkshire Hathaway portfolio. And because it's been such a big winner, it has insanely concentrated the Berkshire portfolio. About half of Berkshire Hathaway's investment portfolio is invested in Apple stock. Part of that is because it's been such a big winner, but also part of it is because Berkshire Hathaway, under Buffett's direction, has invested more dollars in Apple stock than any other stock the company has ever bought. A couple of things that are important to note too. Apple stock, frankly, and Berkshire has been a winner because of this, has benefited from multiple expansion. What does that mean? The stock has gotten more expensive on an earnings basis, a cash flow basis, just about any way you want to look at it. That's driven the stock value up a substantial amount over the past 8 years. But Buffett wasn't buying it when it was expensive. This is a third lesson that I think we can highlight here. Apple is a large company. It has pretty predictable revenues, stable cash flows. So you can use a metric like price to free cash flow to establish a good valuation for a company like Apple. I've taken this chart and I've gone back to 2010 because I want to lay out a little bit of a cadence here. Back in 2010, Apple stock was still trading above 16 times earnings. In 2011, you see right here along this way, Steve Jobs passed. Steve Jobs died. Tim Cook was made the permanent CEO of the company. And for a significant period, Apple stock traded for a substantial discount to its prior multiple. But here we go. This is 2016. This is when Berkshire started buying those Apple shares. What is the lesson? This third lesson is valuation really matters, especially for these big, large, profitable companies where you have some predictability, you have some history of evidence of what can be a really good price. So even as much as Warren Buffett has evolved over the years from that cigar butt style deep value investing that he learned under Ben Graham, that he practiced really through the 70s and into the 80s, he still has a basic foundation of thinking about valuation. His famous quote is, buying a wonderful business at a fair price beats buying a fair business at a wonderful price. But what Buffett saw back in 2016 was a wonderful business trading for a wonderful price. Did he expect it to get to 29 times, 30 times free cash flows that we've seen it trade for more recently, and about 25 times at the most recent prices? No, I don't think that was part of Buffett's thesis. I think his thesis was really simple. This is an incredible company. It's one of the most powerful brands in the world, and it's trading for some of the cheapest cash flow multiples we've seen it trade for in a very long time. I'm going to buy it. I'm going to buy a lot of it, and I'm going to be happy I did. That's certainly proved to be the case. Let's talk again about the 3 lessons that I think investors can learn from this that we can apply to our own investing process. Number 1, don't expect to beat the market every time you buy a stock. Batting average is less important than slugging percentage. Does that mean to take on more risk? No, but it's a reminder that when you find great businesses that are trading for really cheap valuations and you can be patient and hold them for the long term, generally that's going to pay off really well. And it's going to pay off so much that it's going to make up for the occasional mistake that you make. Number 2, think about diversifying your portfolio, but also be willing when you see the right opportunities to maybe concentrate a little bit. This isn't direct advice for anybody specifically, and it might not be the right advice for you, but sometimes taking a little bit larger position where you have high conviction can really pay off with outsized returns over the long term. Number 3, think long term. We know that has certainly been the case for Berkshire Hathaway. I'm going to share one more thing on the screen here. This is from Buffett's annual letter that came out not too long ago. Here at the very bottom, this is the compounded gain of Berkshire Hathaway shares since 1965 through the end of 2023, and it has nearly doubled the S&P 500 over that period of time on an annualized basis. And then we look at the overall gain. S&P 500 is up 31,000%. Berkshire Hathaway up 4.4 million %. The key is thinking extra, ultra long-term with your investing dollars. And that's how you really create wealth. I hope you learned something from this video. I encourage you again, if you want some more great stock ideas, go to our special link, fool.com/unscripted. The Motley Fool's got some great investing ideas for you. Check out that link. We'll see you on the next video.